Hi, this is Alan Gassman, and I'm almost here with Jerry Hesch, Professor Jerry Hesch. Jerry's having some technical difficulties, so he'll try to be joining us while we go here. If he does, he does. If he doesn't, he'll be with us next week. But he's a good-looking guy there, isn't he? So I was going to play a Bryan Adams, Lucio Pavarotti video, one of my favorites, and I'll play it at the very end. So if you stick around, you'll be able to see it. If not, then you can check out YouTube later and watch it alone instead of with all of your tax friends. Here's the theme for today. It wasn't raining when Noah built the ark. And if you need to get some estate tax planning done as a professional with clients who need to get this done, or as a taxpayer, guess what? It's starting to sprinkle. The House Ways and Means Committee on September 13th passed a proposed bill, 881 pages of specific legislation, and it all makes pretty good sense. There's some things I would change if I wanted to raise taxes. There's some things I would tweak, but overall, it's good news for tax professionals because it's not all that complicated. They're just raising rates and taking some planning opportunities away, especially for people who earn more than $400,000 a year. So a lot of tax professionals are definitely going to earn more than $400,000 a year this year and next year as a result of all of this. But there's another video I'm going to play for you having to do with that, and I'll get to that later. Now, if you don't subscribe to our law firm's Thursday report, then you are very lucky. And many, in fact, most people in the United States of America do not subscribe to the Thursday report. We just issued issue number 312. That's 312 times we have irritated hundreds of people by sending this report out. It is absolutely free and almost worth the cost. But this Thursday's edition I thought was especially good. We covered the possible estate tax changes, the possible income tax changes, and avoiding estate and trust litigation. So feel free to access the Thursday report. And if you're researching things having to do with estate planning or tax, put in Credit Shelter Trust Thursday report or Community Property Trust Thursday report in Google, and a lot of times it does come up. And this week we did a theme on Bruce Springsteen. So if you like Bruce Springsteen, you definitely want to see the Thursday report. Okay, Kelsey's working with Jerry, so we're not going to be able to show you one of my favorite YouTube videos by Dan Sullivan until she gets back and shows me how to play it. In the not so free department, a lot of people have been giving us good feedback on our Lineberg presentations. There's a 90-minute presentation that Brandon and I gave on the 28th on this new tax law and other presentations that you see here. If you're a professional, there's a free one here on the Notre Dame Institute. We encourage you to attend the Notre Dame Institute as well as the other institutes that you see here. And if Jerry's able to join us, we'll talk more about the Notre Dame Institute because there's a lot of opportunities in that particular institute. Okay, so the first thing I wanted to share today, and I'm looking over to my right here to find it, is a spreadsheet that you are getting. And Brandon updated the spreadsheet this week. And here's what we have. In green on the left, the exemption amounts for a single person if the law continues and it doesn't go down. That's on the left, and we've assumed a chained inflation rate of 2.5%. Now, the exemption goes up not by inflation, not by the consumer price index, but by chained inflation. That has nothing to do with S&M. Chained inflation just doesn't take into account a few things in the economy and is generally about 2/3 of the rate of normal inflation. So that's not going to do us a whole lot of good. Then if the exemption goes to half in 2026, so that's what it's scheduled to do now. If there's no act by the Senate, the Congress, and the President, and the House and the President by 2026, and we have chained inflation of 2.5%, that exemption is going to $6.6 million per person in 2026. Now,
Alan, can you hear me?
I hear you great, Jerry, and you
But
look good. You look like a camera.
I know I can't. Okay, for some reason I can't get the camera to focus on me, so I'm not going to touch anything else.
Okay. All right. Well, listen in, and I'll clue you in a second. And welcome to the presentation, Jerry.
I can see the slides, by the way.
Okay. All right. That's good. And you look good as a camera. So, okay. So number 5 here, we have what would happen under the new bill. Now, under the new bill released by the House Ways and Means Committee on September 13, the exemption would go down to half of what it would otherwise be on January 1st, 2022. So if this bill passes, everyone will have until December 31st to use that exemption. But remember, you cannot use the exemption by transferring assets to what we call a defective grant or trust after the date that the president signs the new bill. So people who are well advised are going to move faster. And if they're going to make a gift, they should think about it now, what they're going to do. And some clients have already signed documents to forgive promissory notes that are owed to them by trusts and have given us an escrow agreement that says, if and when I send you an email to release this document, then I want you to release the document so the loan will be forgiven. So I will use a substantial portion of what's left of my $11,700,000 exemption. And then the client doesn't have to worry about whether we're going to be too busy that week to get anything done. Jerry, here's the biggest question I get over and over again. And with your experience, you're going to be one of the best people to answer this. How much time will there be between the time that we see on the news that most senators and most congressmen have agreed on a new tax bill and it's expected to be passed by the Senate and signed by the president? Will we have a week? Will we have a day? How long do we normally have?
Probably to the end of October, if everything goes as quickly as possible, because right now, the House Ways and Means Committee, when the bill was introduced, they didn't have any hearings at all. They just sent it over to the House Budget Committee a few days later. The Budget Committee will, do their financial markups, send it back to the House Ways and Means Committee, which will probably happen probably the first thing this week, like on Monday or Tuesday. The Ways and Means Committee will then pass it on a party line vote. It will then go to the full House of Representatives, and they will pass it quickly on a full party line vote. And so what happens is by sometime next week, probably towards the end of next week, it goes over to the Senate. And then the Senate Finance Committee will, if they want to streamline it through, the Senate Finance Committee will make some changes here and there, a little bit of changes. That'll take like another week. Then, because there are changes between the House and Senate bills, it goes to the Conference Committee, and that will take, they got to appoint a conference, the members of the House and Senate to be on the Conference Committee, and that will take about another week or so. So essentially, if it goes through as quick as it did with the Trump bill in 2000, remember, in Trump in 2017, that thing went through without any hearings, nothing, just bang, 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 and that still took several weeks. But the point is that when it comes out of the House Ways and Means Committee and sent to the Senate, it still has time. There'll still be time. When the Senate, the Senate could take longer for all practical purposes, but you can't risk anything, and so basically assume that if it's fast tracked, it will be done by the 4th week in October.
And what do you think the very earliest it could be? Because there's been people saying it could be as early as October 1st. Is that completely unrealistic?
October 1st is this Friday.
That's true. That's true.
It's totally unrealistic. 3 weeks, if it's extremely fast tracked, but I just don't see the Senate, just rubber stamping the House bill, because there's a number of people in the Senate that aren't terribly keen on some of the stuff.
So Jerry, let me go ahead and introduce you. The first thing I'd like to say, because our audience here is about half tax professionals and half interested taxpayers, and maybe we should issue everybody a badge that says I am a taxpayer and I watch the Saturday show. But if you were to go to 100 tax and estate planning lawyers and say who most influenced you, mentored you, and helped you in your career, high on the list would be Jerry Hesch. And in my opinion, he's way ahead of whoever number 2 is, because Jerry has been a professor of estate planning and estate tax and income tax law for a number of decades, and shares both his brilliance, his enthusiasm, and his warmth with his students. And I have considered myself to be a student of Jerry's ever since I saw him give a lecture in 1984 when I was a young lawyer. And anything that Jerry's ever written, I have made sure that I need to read, because he's a very advanced thinker and, quite frankly, a very good guy. And, one silver lining of the Vietnam War was that Jerry, then a mathematician, went to law school to beat the draft. And we're all fortunate for that. So Jerry, I know you spent some time on Capitol Hill as a young, bright tax lawyer. You spent some time with Gerald Ford on the Joint Committee. What is the Joint Committee, and just what is that like?
And not the Joint Committee. I did some work for the White House staff. That's different.
Okay.
The Joint Committee of Taxation is the members of the House and Senate have a special study group, basically, that focuses solely on federal taxes. And the Joint Committee has a full-time staff of trained lawyers and economists and financial types that evaluate all of the bills and everything. So it's like Congress's think tank, basically. Okay. And a lot of, because the House and Senate, the Ways and Means Committee and the Senate Finance Committee, they have their own staff, but they have to not only focus on tax bills, but everything else comes up. So the Joint Committee is like Congress's think tank.
Beautiful. Okay, so Jerry, I'm going to go back to my spreadsheet here for everybody. Let me find where I put it. So the way the spreadsheet works, I showed you green is the present law, and now I've got a married couple up here. Green is present law. Yellow is if it goes to half as scheduled in 2026. Blue is if it goes to half next year. And then number 6 is your client. So, and then you can go ahead and select a growth rate, select a net worth, and then it will tell you how these laws will impact your client. So for example, if I want to go ahead and have a net worth of the married couple of 14 million, they're not that concerned. Their growth rate is 7.25%, which means that it will double every year. I mean, every 10 years on average. And then in addition to that, they're saving $130,000 a year every year for the next 10 years. And then they're going to retire. They're not going to save anymore. Do they have an issue? Well, under the present estate tax law, they don't have an issue unless they're going to live longer than 11 years. But then they do have an issue under the present law in the books going to half in 2026. They've got a $3 million issue in 2026. And under this new proposed law, they have an issue immediately as of next year. So that's just a spreadsheet that you can use. And we actually have used this spreadsheet in some pretty sophisticated situations to show the client, here's your spreadsheet before the planning. Then we just do a separate one. Here's your spreadsheet after the planning. And then we have another one that compares the two spreadsheets that Denicolo just handled. So we have that for you here. And let me figure out how to get back to my PowerPoint slides. Okay, another thing we have here, and I know there's not time to go through all this, but we have our full Lineberg explanation letter on the estate tax law that was published last week. So I've put it here, and you can read it off the PowerPoint slides. And let me just mention, a few things that happen. I think everyone on this webinar knows, but the exemption goes down to half December 31st. The ability to take discounts on things other than active business assets would be gone on the date of enactment. The ability to add value to a trust that is disregarded for income tax purposes would be gone the day of enactment as a practical matter. And
Alan,
yes,
Alan,
yes.
There's two kinds of trusts, grantor trusts and non-grantor trusts. The bill is focused on grantor trusts. Non-grantor trusts are not affected by any of this. So what we're recommending is, after the enactment, if you still want to do your estate and income tax planning, the grantor trust will not be available, but non-grantor trusts will still be available.
Great. Okay, and we're going to talk more about that. Now, the way it's written, we believe that qualified personal residence trusts will be gone, and we're going to talk a little bit more about qualified personal residence trusts today, because they're very, very popular this week. Grantor retained annuity trusts would be gone, and grantor clats would be gone. And Jerry is one of the foremost authorities in the United States on grantor clats. Jerry, do you want to just spend 2 or 3 minutes on grantor clats?
Yeah. Grantor clats are very simple. They're primarily used as an estate planning. Well, there's two kinds of charitable lead annuity trusts. Ones that are grantor trusts and then ones that are non-grantor trusts. Both trusts, both forms can be used for estate planning. However, what happens is somebody needs a large charitable income tax deduction up front. And so what you do is you create a charitable lead annuity trust and you determine the present value of the annuity that the charity will receive over the trust term. And that is a charitable gift tax deduction. And if it's a grant or a clat, it's a charitable income tax deduction. So for people who are going to be in a very high income tax bracket for one reason or another, because they have a large amount of income and they want to generate a large income tax deduction, you use a grant or clat, which gives you a charitable deduction for income tax purposes equal to the present value of the future annuity payments. And it's very advantageous because there's a drawback to a grant or clat. If you're getting a charitable income tax deduction for the future income going to the charity, then you're going to have to report the income in the future on your income tax return. But if you're in a lower income tax bracket in the future, it's still advantageous.
So instead of giving $1 million of appreciated stock to charity, I could put $1 million of appreciated stock into a grant or clat. The grant or clat would pay a certain amount a year to charity for a certain number of years. I would get a tax deduction for the entire $1 million amount, even though at the end of the term of years, what doesn't go to the charity, what's left over, goes to my descendants. And there's no gift tax cost of that. It's not in my estate for estate tax purposes. So Jerry, what is what we call the hurdle rate? What rate of return do the assets in the CLAT have to earn in order for there to be something for my children at the end of a 15-year grant or CLAT?
It's actually very simple, okay? And I like to use a simple example. Remember, my forte is not what I know, but my ability to communicate it in an understandable manner. That's why I developed the following, not because I was brighter than anybody else, but I knew how to communicate it better. And that comes from being a law school professor. It's very simple. If I can borrow $1 million at 1% interest, and I take the loan proceeds and invest it at 3%, the extra $20,000 I earn on the $1 million I keep. So all that happens is for the charitable lead trust is essentially, if you earn more, the hurdle rate is very simple. It's a mandated rate under the Internal Revenue Code, which is based on current market rates, the 1-year Treasury bill rate. So essentially, a CLAT assumes that the $1 million you put in the CLAT is going to earn 1%. And so the CLAT assumes that the charity will get 1%. However, if the $1 million earns 3%, that $20,000 buildup in the charitable lead trust passes to your children at the end of the charitable lead trust term, free of all estate and gift taxes. So it's just a question of being able to earn a rate of return in excess of this arbitrarily low 1% hurdle rate that's in effect today.
So I put $1 million worth of Google stock that only cost me $100,000 in this CLAT. I get $1 million tax deduction. The CLAT pays $110,000 a year to my family foundation. And at the end of 20 years, there's $600,000 left in the CLAT, and it goes to my children or a trust for my children, gift tax free.
Exactly.
Why would anyone give directly to charity when you could do a grant or CLAT instead?
And there's because not only you get the income tax deduction up front if you need it, but it's an estate planning advantage. So what we're saying here, very simple, is instead of giving money outright to the charity, which means the charity gets the benefit of all the income and the appreciation in value, use charitable trusts, charitable split interest trusts, like a charitable lead trust, so that the earnings in excess of this very low hurdle rate can pass to your children free of estate and gift taxes.
Right. And if your accountant or lawyer doesn't understand these, the chances are that there are people working for the charities that you would support who can explain them. Now, Jerry, on page 27, here's another question I get. If there is a tax law change, will it be pretty much what we see from the House Ways and Means Committee, or is there still a chance that we could lose our capital gains step up on death, or that it could be significantly different than what's been proposed?
I haven't a clue.
That means no one on earth has a clue.
Right.
So it could be different. I was thinking it would not be that different, but
well, it depends. If the Democratic Party can ramrod the thing through but they need every single senator to go in favor of it, and there's 3 or 4 senators in the Democratic Party who are not thrilled with some of the provisions in the bill. Now, interestingly enough, the Biden administration smartly did not add some of the craziness that was proposed. For example, in the bill is still step up in basis at death. They're not going to have that. And in the bill, they did not say that you have to pay income tax on any appreciated property that you bequeath to your descendants. That's not, those two major things are not in the bill, and they're unlikely to come back. Well, I think maybe, who knows?
Right. Okay. And I think everybody who's watching knows that there's a lot of slides here with a lot of information. Now, if you or your client are thinking about making a large gift because you're afraid you're going to lose that exemption, it's always a good idea to make the gift. It's going to save estate tax, but unless you have given and give more than half of your exemption, it's not going to save what you're going to lose. So that is, I ran through this Mrs. Jones example last Saturday, but I have it here in case anyone wants to go through it. And of course, for new viewers. Now, Jerry, I want to talk a little bit about the Qualified Personal Residence Trust, because now it's real popular, because anything that you take away becomes very popular just before you take it away. And the way a Qualified Personal Residence Trust works is that I put my home in a trust, and I retain the right to live there and use it and do anything I want with the home for the first 8 years or whatever number of years I choose. And then after that, it's an irrevocable trust for my wife and my children. It's out of my estate as long as I live the 8 years. If I die during the 8 years, then it's in my estate. And that is, of course, unfortunate. But the gift I made to put it in, if I die within the 8 years, gets reversed out. The trust is disregarded for income tax purposes, which is why it won't be around if the House bill passes. Once the 8 years has passed, I can use the house, but I have to start paying rent. The good news is when I pay the rent, that reduces the value of my estate. So we have a spreadsheet here that we've covered before, but I want to show it to you, Jerry. Our law students put it together and they did a really nice job. So I have a $2 million house. It's growing at 3.5% a year. And I'm going to turn that growth rate down because quite honestly, houses don't grow on average at 3.5% a year. I'll move that down to 3%. And by the way, when you see that the median house in your area grows by 3.5% a year, your house is not the median house. Your house is a little different. Your house gets older every year, and your house needs repairs. So typically, houses over the last 60 years have not been great investments. If you think about what you've had to pay to keep the roof fixed and redo your plumbing and all that, it has not kept up with stocks and bonds, although it's been pretty good the last year. So anyway, I've got a $2 million house. It's going to grow at 3% a year. If and when I have to start paying rent, I'm going to say that the rent is going to be based upon 8% of the value of the house. And then I'm going to go ahead and have, let's say, I'll make it an 8-year Cupert or a 9-year Cupert. And I'm going to have, when I reinvest the money that the rent is account that goes in, I'm going to earn 7% rate of return on that. And I'm going to use $635,000 of my exemption. That one is wrong. That one needs to be a higher number. So that may be $1,400,000. So now, what have I done here? Well, actually, let me move the house down to $1 million. So if the house is $1 million, I've used $635,000 of my exemption. What happens if I live until year 12? In year 12, the house is going to be worth $1.3 million. It's out of my estate because I've lived past the term. I've paid $110,000 of rent. The rent's been reinvested at 7%, and my estate reduction is $1.7 million. The house plus what's been reinvested. I've used $635,000 of my exemption, so the estate tax savings is $437,000. So that is the reason to consider the qualified personal residence trust. So Jerry, I've got one question for you here. I set up a Cooper, and it's 8 years I get to use the house for free. After the 8th year, my wife Marcia has the right to use the house. She's the lifetime beneficiary of the trust. She's the trustee. She has the right to receive trust benefits as needed for her health, education, and maintenance. That includes the right to live in the house. And even though she has all those powers, the trust will not be included in her estate for estate tax purposes. Now, if she has the right to live in the house, does she have the right to let me live there without paying rent? Or am I required to pay rent to keep this out of my estate for estate tax purposes?
This is a family law issue, okay? And if remember, the federal tax consequences depend upon your legal rights and duties under state law. And given that it's going to be your principal residence, okay, does your spouse have an ability or an interest to live in the house without paying rent? In other words, there's a very old case from 30 years ago, I remember, where a couple was married and the wife had a home in her name only when they got married, and they never changed the title. And then for some reason, 20 years down the road, she kicked them out of the house, and the court said, you can't do that. He has a legal right under state law to live in your house because he's your spouse. So what I'm saying is, based on state law, there's no requirement that he has to pay rent. He has a right to live in it, but under state law, so I don't think it really would create a problem. Plus, okay. I don't see. I mean, but that's just my analysis.
Okay, very good. So on page 41, for the tax advisors at least, if a 56-year-old has a $2,140,000 house owned jointly with a spouse, donates half the house to a Cooper, assuming that 50% of a $2,140,000 house is really only worth $909,000, you take a discount because who the heck would want to buy half a house? That's a 15% discount, which has been allowed in at least one tax court case called the Williams case. If you do a 10-year Cooper, the discount, because of the fact that the trust doesn't vest in the remainder people until year 10, you get a discount of 47%. So it's only a gift of $581,000. Now, if you go 15 years, it's a gift of about 52%. So it's only a $443,000 gift. What I ask the client is, how long will you live? Are you healthy? I like to use an age that you have an 80% chance of living to. So a 56-year-old has an 80% chance of going to 76 for sure. So I wouldn't hesitate to use a longer period. But the interesting thing, Jerry, is that if you're going to pay rent, you may actually come out ahead using a shorter period because the rent makes up for the differential.
Exactly.
So, Jerry, I know you and others have often said that it might be better for me just to donate my half of the house to a spousal limited access trust right off the bat. So I would make what would be considered to be a $909,000 gift to Marcia, my wife, as trustee of a trust that would pay her what she needs for health, education, and maintenance, and that would include the right to live in the house. I would use $909,000 of my exemption, but I would have to pay rent beginning immediately. And of course, because the SLAT, Spousal Limited Access Trust, is disregarded for income tax purposes, it would not have to pay any income tax on the rent wouldn't be considered to be payable for income tax purposes. So Jerry, how do I determine, is it better to do a Cupert or is it better to do a slat?
Well, look at it this way, Alan. You just went into all sorts of detailed minutia, and try communicating that to your clients. All right. So wouldn't it be simpler to just say, why don't I make a gift of the house using its current discounted value outright to a trust for the benefit of my spouse and my descendants right now, and then rent it back immediately? In other words, not even bother with the Cupert. Because if you do a gift lease back, there's no risk of dying during the Cupert term. Okay.
That's true.
If the client, but you know, the client doesn't want to make a large gift, or for whatever reason. So the most important point is to show all the different variables of the planning for your principal residence and one other residence, because you can use it for a vacation home, and communicate all the variables and the different things so that the client can make a reasoned decision of which of the alternatives would be most practical for their station in life and their personal concerns.
Right.
There's no one solution. You just have to explain the different solutions, and so the client can make a reasonable decision.
Right. Okay. Very good. So I've got some other slides here that I've used in the past. Let me see what I want to go to here. Not that one. So Jerry, here's a situation that I'm seeing a lot of, that I'm interested in your thoughts on. The clients are 62 years old, husband, Doug, he's a retired doctor. Samantha's 58. They've got about $10 million of personal real estate. They're thinking about buying a $12 million home, and they've got about $21 million worth of assets in a family limited partnership, and they'd like to not pay estate tax. Now, they've already done some fantastic planning. We've got a spousal limited access trust that Doug set up for Samantha and the children, worth about $40 million. And we've got a trust that Samantha set up for the children that's worth about $40 million. So we've already got about $80 million out of their estate. But they would like to pay no estate tax, but they'd also like to continue spending with a lifestyle where they can spend about $700,000 to $800,000 a year. So
so we're focusing on is the remaining 21 million of their investment assets, right?
That's right.
And so we have two trusts that are funded with $40 million each. Okay. So the first question is, if you wanted to sell an asset to a trust with $10,000 or a trust with $40 million, which trust would you feel more comfortable with? If you're going to sell an asset and it's going to be a promissory note for the entire purchase price.
Yeah, I would be glad to take a $10,000 note from a $40 million trust.
No, like a $20 million note from a $40 million trust, as opposed to a $20 million note for a trust with only $10,000.
Yeah. Okay. All right.
All right. So what you show here is very simply is, and I'm assuming because they've done significant estate planning, they probably used all of their gift tax exemptions. Let's assume they've already fully utilized their full 11 million gift tax exemptions. But even if they haven't fully utilized their gift tax exemptions, they cannot afford to give more away because they need the income from that 21 million. So someone would say, hey, even if you have more gift tax exemption, give away some of that 21 million. But then what are they going to live on? All right. So basically, what you would like to do is, while you can still do it. Now, interestingly enough, this still can be done. This planning still can be done before year end or before the effective date. If the laws change, then it will be limited. So what you could do is basically take that $21 million, which is already in a family entity, and take a reasonable discount. Now, what kind of discount should you take on 21 million? Remember that the IRS has limited ability to audit every gift tax return that has a valuation report. So if you take a conservative discount in the 15 to 20% range, and all these other valuation reports are taking 35 to 40% discounts, what are the chances that they're going to pick your gift tax return to challenge the size of the discount?
Pretty low.
Because the client is going to tell you, I want to be as aggressive as possible, but I don't want to be audited. So that's why, but the discounts, in the long run aren't that significant because it's a one-shot deal. So the question is very simple: is let's take a discount on the 20 million to 18 million. And then the next thing to do is basically sell all or a part of that 18 million. Now, the nice thing is to sell it to the trust for the benefit of my spouse, because that means that whatever financial benefit that sale to the trust is, it's in a trust for the benefit of my spouse. So the first thing I can do is just basically say, I'll sell to the trust for the benefit of my spouse out of that 18 million, and I always want the client to keep something. Don't sell everything. So let's suppose out of the 18 million, they say, let's sell 10 million to the Green Trust for a interest-only promissory note. Now that promissory note can be at 2%. So that's a pretty nice spread. And of course, the extra funds in the trust, your spouse is a beneficiary, so if the interest isn't enough. But the problem with a promissory note is very simple. It is that 10 million promissory note is frozen in your estate, and you're going to get paid that. If you die with the note, it's a note for 10 million that's in your estate. So is there a alternative where, for some reason, Alan, that when the husband dies, that promissory note can be canceled or go away?
Yes, it's the self-canceling installment note.
Right. And a self-canceling installment note is very simple. You just increase the interest rate on the note from, say, 2% to 5%, and it's a 10-year note or a 20-year note. And if it cancels during Doug's life, if Doug dies while the note is still outstanding, it's canceled. So Doug is healthy, and we expect him to live another 20 years, but in the unforeseen event he dies unexpectedly in the 20-year period, the note cancels. So one alternative is a self-canceling installment note. But Doug says, but what if I'm still alive at the end of 20 years? Is there another way that $10 million that's providing me with an annual cash flow can go away and not be included in my gross estate, Alan?
That would be, you could move back the due date, which would increase the interest rate.
Or
private annuity. Right.
Right. In other words, what Doug does with the $10 million is he buys an annuity from the SLAT that provides him with an annual annuity payment for the rest of his life. And because the annuity is a contract that says all you're entitled to is the annual annuity payment, when you die, the trust that issues the annuity doesn't have to give you anything back. So the nice thing about it is that if Doug, the risk with a skin is, and he's healthy, if he's still alive at the maturity of the note, the cancellation feature is irrelevant. So an alternative is to Doug to buy an annuity from the spousal limited access trust. And which technique we actually use has to do with a sophisticated financial analysis. You have to understand what are their cash flow needs, what's their station in life, and all these other subjective factors to custom design it. But having two trusts out there that are adequately funded gives you a lot of planning flexibility to use those two trusts.
Jerry, if we see at the bottom left-hand side here that the annual payment would be on a private annuity would be 5.66% a year. So on $14 million, if we go with a $14 million,
I like to say 5.66% on 10 million, so you can do the math in your head.
Right, $566,000 a year. What if he wants more cash flow than that? Can we just make it more? Can we make it a 7 or 8%? Because if we can show that a commercial
annuity is fixed. In a situation like that, what we might do is not do everything for the annuity, but do a combination of a self-canceling. Remember, a self-canceling installment note, we hope he doesn't die during the note term. It's just for the unexpected, but I might do a combination of a private annuity and a self-canceling installment note. In other words, the financial analysis is which techniques to consider, how much to devote to each technique, and figure out the combination of techniques to accomplish all their financial objectives.
Right. Now, Jerry, I've explained to the clients as we go through this discussion that they can toggle off the descendants trust. So they're going to have to pay the income tax on the income of these trusts. And if this limited partnership sells its assets for $30 million and has a low basis, they're going to have to pay a lot of income tax. So my first question is, before such a transaction, to toggle off grantor trust status on the descendants trust and not trigger income tax, the descendants trust probably has to pay the note off first, right?
Well, no, if you toggle off grantor trust status, the note just comes into existence for income tax purposes, which means the owner of the note has to report interest income, and the obligor in the note has to report an interest deduction. The only problem is the note comes into existence for income tax purposes, and if you sold an appreciated asset, then you have an income taxable installment sale. So the advice is, before you toggle off grantor trust status, make sure the entire note is paid.
What if it's not a note? What if it's a life annuity?
Well, that is a problem. See, that's why the nice thing about the annuity is that what we do in that situation is we increase the annuity payments, say 1 or 2 or 3% a year. So we can custom design the annuity to pay him more annuity payments as the assets in the trust get larger, which in the increase in the annuity payments covers the income tax the extra income taxes he has to pay on the trust income.
So instead of starting at 5.68%, it might start at 3% and then go 3.5%, and then 4%, then 5%, and go up. And okay.
Remember, the key is that not there. Too many planners. Here's your solutions. Bang. And what you really want is somebody who evaluates the client's personal station in life, their financial needs, their financial position, and then show them all the different techniques so that they design the structure with you.
Now, Jerry, on the spousal limited access trust, the law is not really clear on whether you'll be able to toggle that off. So if the spousal limited access trust is going to have a high income event by selling an appreciated asset, do you think that Congress is going to fix the laws to make it more clear that you can toggle off a slat? Because you remember they deleted Section 682 in the 2017 Act, I think accidentally. What's your thinking on that, or do you know?
Alan, the reason I don't invest in the stock market is because I don't know either.
Okay. All right. Okay, well, thanks for your thinking on that. So we had some questions from the, I want to make sure that everybody knows, because of the step transaction doctrine, Jerry says we have till late October for this bill to pass. Please don't call my office on October 28th and say, I'm ready to get started. Can I put my assets in an LLC and do a sale for a discount? Because the answer may be, no, it's too late. You've got to put the assets in the limited partnership or in the LLC. We like to wait a month, but we'll wait as long as we can before the sale or transfer of that non-voting member interest or that LLC, that limited partnership interest. So just keep that in mind. Now, in the Holman case, they only waited 6 days between putting the assets in the limited partnership and making the transfer, but it was all Dell stock, and the court said that was a very volatile asset, so you didn't have to wait so long. If you're doing this with real estate or with blue chip stocks or bonds, you're going to want to wait a longer period of time. So here's the questions I had for Jerry. He's answered number 1. He's answered number 2. He's answered number 3. He's answered number 4. Okay, here's number 5. Let's say I can't toggle off grantor trust status. So I've got this beautiful trust for my beautiful wife, and it generates a lot of income, and I can't afford to pay all the income, and it becomes a black star, and it's causing me to lose all my assets, and I'm going to be destitute. If Marcia and I file a joint income tax return, even though the income is really mine because I'm the grantor of the slat, because we signed the joint return, it's half her responsibility. Can the slat pay half of the taxes?
Actually, interestingly enough, when your wife signs a joint return, okay, and half of the income is hers and half is yours, and she knows, and there's nothing hanky, and you don't pay any of the income taxes on it, can the IRS legally go against your wife for not only her half of the income taxes, but your half?
Absolutely. A joint return is like a joint note.
It's joint and several liability. So because under federal law, she has a liability to pay the income taxes, there should be no problem. And if the IRS says, well, by her paying your income tax liability, she's made a gift, so what? It's the marital deduction. So therefore, that's why spousal limited access trusts are a wonderful technique when you just want you make your spouse a beneficiary. You should always consider that. What happens if you get divorced?
You're in big trouble if you get divorced, but our slats normally say that on divorce, the slat divides in two. One trust continues for the spouse. The other trust usually is in Nevada. The slats are in Nevada. The other trust is directed as to the trusteeship by the grantor, and there's trust protectors who would hopefully add me back. Is that the right answer?
But there's solutions. A lot of people say in the boilerplate, there's a special definition of a spouse saying it's the person I'm legally married to at the time. And in some states, that's not enforceable.
Yeah, I mean, I gave a draft SLAT agreement to Marcia, and it has a provision in it that says if Marcia's no longer Alan's spouse, because she's passed away, then his next spouse is the lifetime beneficiary of the trust. She hasn't read the SLAT yet, but when she reads that paragraph, I don't think she's going to like it, Jerry.
I
So
know.
it makes a lot of sense to me, but it doesn't make a lot of sense to her. Okay. And then question number 6, why is it that the air conditioner in your Triumph never breaks?
Well, I bought a Triumph sports car in 1968. And the reason I've never spent a dime on air conditioning repairs, it didn't come with air conditioning.
And you still drive it, and is it your only car to this day in Miami, Florida?
No, it was it was British Racing Green, and I bought it in 1968. Then I saw the movie The Graduate, where he drove a red Alfa Romeo, and I said maybe I should have gotten a red sports car. So a few years ago, I found the 1987 red Alfa Romeo Spider and bought that.
Oh, nice. And you still ride your motorcycle, your Triumph motorcycle.
Yeah, but not as much anymore.
Yeah. So Jerry, we only have like 2 or 3 minutes here. What do you think is going to happen with irrevocable life insurance trusts? Because they're automatically a grantor trust. Do you think the life insurance industry will just lobby and get this thing handled, or how will life insurance trust change?
Well, let's assume that nothing happens. So what you basically do is you have to draft your life insurance trusts so they're not grantor trusts. So basically, you say that the only thing that can be used to pay the life insurance premiums is principal, not income. So every year the person makes annual exclusion gifts of principal, and that's used to pay the premiums. So you have to be careful and not say that your life insurance trust can be paid, the premiums can be paid out of income. Limit it to only principal.
And that'll keep it from being a grantor trust. I mean, do you think there should be a mad rush right now to put life insurance policies and life insurance trusts while we can?
The problem I have is when you're starting to do things with a mad rush and they're irrevocable, what happens if things change a year later?
I know. That's why you have to have trust protectors who can change it around, but it's hard to give it back. Maybe you put it in as a split dollar advance, and then if it's not looking good, you just pull it right back, I guess.
Well, the easiest thing is to every year lend the money to the trust, and the trust uses the loan proceeds to pay the life insurance premium.
Okay. All right. Very good. So we're at the hour now, and there's so much more I wanted to cover. Jerry, you sent me some slides. Let me find them here. I've got them here somewhere.
Well, this is very important.
Yeah. So let me, Jerry, before I go into this, my suggestion is that most of the laymen on the talk here, you may not want to go forward, or you may find what Jerry's about to say is not as much of interest to you. So if you're going to sign off, that's fine. You've got our email addresses. If you want to send any questions, just send me the easy ones and Jerry the hard ones, as always. And I hope to have Jerry back next week or anytime Jerry wants to come. He's always welcome. Jerry, is there anything you want to say before we get into this next section on income tax deferral for selling appreciated assets?
Well, the point I raised way back in the beginning, all of the legislative proposals deal only with grantor trusts. And so if you have clients who did not do their pre-enactment planning, the law comes in, you can't use grantor trusts anymore for estate planning. Does that mean that everything is gone? And the answer is no. You can still use non-grantor trusts. The problem is, in order for the trust to not be a grantor trust, it cannot be for the benefit of your spouse. It can only be for the benefit of your descendants. So that's a limitation. But a lot of the estate planning techniques that we have used in the past with grantor trusts can be readily adapted for non-grantor trusts as well. For example, let me give you a simple example. An individual has $10 million of cash and he has an opportunity to invest that $10 million in a real estate venture that they know is going to make a lot of money. So what the individual does is they lend the $10 million on a 20-year interest-only promissory note to the trust. The interest rate that can be charged is as little as 2%. So what that means, the individual lends $10 million to the trust, takes back a $10 million interest-only promissory note at 2% with all principal due in 20 years. Because it's a complex non-grantor trust, $200,000 of interest income and $200,000 of interest expenses are reported each year. The trust then takes the $10 million and uses it for a acquisition of debt finance real estate. And if the debt finance real estate after the payment of the mortgage exceeds 2%, the non-grantor trust keeps the spread. And more importantly, if the real estate appreciates in value, it's all with the trust. So there are plenty of transactions that are still available if the law changes and you haven't done your planning before. And what the slides are designed to do is show all the little things. I'm assuming this is done after the effective date. Want me to go on or what?
Yeah. Please
Okay.
do. I think this is mostly the tax professionals who are left here.
Okay. Now we got 309 people left.
Well,
All
a lot of them fell asleep.
Okay. All right. So under the proposed legislation, two things. Number one, any grantor or trust created after the effective date, even though it's an irrevocable trust, will be included in the grantor's gross estate when they die. So effectively, nobody's going to start creating grantor trusts after the effective date. But here's something interesting. Remember, the technique we used to use was an installment sale to a grantor trust because there was no income tax sale. So Code Section 1062 basically says, if you sell an appreciated asset to a grantor trust, you're going to have to treat that as an income tax realization event and report the gain for income tax purposes, but you can defer the reporting of the gain under the installment method. So all installment sales to grantor trusts that relied on the fact there was no sale, so no gain had to be reported, will now be income tax recognition events. So what? We can still use this for income tax advantages. And the rest of the slides kind of have a number of examples. Okay.
You want to go through one of the examples?
Yeah. Okay, now, remember that Congress said we're going to eliminate valuation discounts for marketable securities. But you can still take valuation discounts for your closely held business. So let's suppose that senior happens to own a family business worth $30 million with an income tax cost of $20 million. So it's an operating business. So if senior wanted to do estate planning with that, they could reasonably discount it for lack of control and lack of marketability to $20 million. Okay? So let's suppose that senior values the business at $20 million with an income tax basis of $20 million. So what does the next slide show you? Okay? He sells the business to the non-grantor trust for an interest-only $20 million installment note. Well, guess what? Basis of 20 million, note of 20 million, there's no gain. So no gain is realized, and so what this means is each year senior reports 400,000 of interest income, and the trust reports a $400,000 interest deduction. So from an overall family point of view, it's income tax neutral. So let's see what happens with that 30 million business that was sold to the trust. Let's assume that the trust just bought this $30 million business and it's earning 5%. Okay, so the trust has $1.5 million of gross income. It has an interest deduction of 400,000. Therefore, the trust has 1.1 million of taxable income. It's in the trust. So what senior has done for an interest payment for a 20 million note is shifted all but $400,000 of the income to the trust that keeps it. So each year, that 1.1 million of excess income is shifted to the trust without any estate and gift tax exposure. Now remember, if it was a grantor trust, senior would have had to pay all the income on 1.5 million. So we haven't increased the income tax burden at all. So what happens is, if this was a sale to a grantor trust, senior would have reported $1.5 million of income and pay the taxes on it. Now, senior reports 400,000 of income, and the trust reports 1.1 million of income. So the income tax costs overall haven't changed. Now, here's what's interesting is, as a grantor trust, the entire 1.5 million would have been taxable to senior at senior's very high income tax rates. Alan.
Yep.
This is a non-grantor regular complex trust that has 1.1 million of taxable income. Taxable if the trust reports it all at the highest income tax rates, and the trust reaches the highest income tax rates at $13,000. Is there a way for this non-grantor trust to assign some of that 1.1 million to taxpayers in lower income tax brackets?
Right. All it has to do is make distributions to individuals or charities during that year or in the first few days of the following year. And that.
So in other words, Alan, is the beneficiaries of that trust are my descendants. My descendants include my adult children and my grandchildren. And what if all the grandchildren are, not earning any income, or just right out of college in their first jobs? Are they in lower income tax brackets?
Absolutely.
So suppose I have a grandchild that just graduated from law school and is earning only $60,000 or $80,000 a year. Does it make sense to shift income from the high bracket trust to them?
Absolutely. Jerry, how can I shift income to them without giving them the money?
Well, you create trust. You
create a 678 trust for each of them and then give the money to the 678 trust. Is that the way to do it?
Well, I like to keep it simple and say, give it to them outright. Giving it outright to your children who are responsible adults is not really a problem. But for your grandchildren, You would have to, consider maybe creating creating a grant or a trust for the benefit of the grandchildren, which is under Code Section 678. That could be a possibility, because remember, the grandchildren may never be exposed to estate taxes. So if it's a grant or trust that's to the grandchildren, who cares?
Yeah, I think the 678 trust is going to be the answer, because a lot of my clients don't have responsible children or grandchildren, or they're worried about creditor protection. They're worried about estate tax protection for the children who are already wealthy. So that'll all have to be worked out somehow.
Yeah. Or basically maybe, put the income into partnership interest where they all get our limited partnership interest, something, whatever it is, there are solutions.
So you want to go to the next slide when the company gets sold?
Yeah, and here's the estate planning benefit. Not only did you shift 1.1 million of income into the trust, but remember, the trust paid 20 million. So the business increases from 30 million to 36 million. And the income taxes, remember, the senior's basis was 20 million. And if it's sold for 36 million, there's 16 million of gain. You can't get around it. So what we have done is the estate plan, in addition to shifting 1.1 million to the trust every year, all of the discount plus the appreciation from 30 million to 36 million is also in the trust. So essentially, your discount planning and your freezing at the discounted value is still available. It just changes some of the income tax ramifications of it. And then we saw the income tax changes, the total income taxes are still going to be paid the same, whether it's a grant or trust or complex trust. So it doesn't really matter. So you can still use complex trusts for estate planning as well.
Okay. And do you want to go ahead and run through the installment method of accounting discussion?
All right. Okay. So here's an interesting situation that is very common. Senior owns a 25% interest in an operating business, and the other 75% owners are unrelated third parties. And Senior has a buyout agreement. Senior is, basically saying, a few years not from now, I'm going to retire, and under the buyout agreement, the remaining partners or shareholders in the business will buy me out. So we look at this, and Senior's basis in the 25% interest is 4 million, and the buyout agreement currently values the business at 16 million. So let's suppose that Senior creates a family trust that's a complex trust for the benefit of my descendants. Since it's a non-grantor trust, that is a sale for income tax purposes. But by the way, it's an installment sale. So if the trust gives Senior a interest-only promissory note with a 20-year maturity, the gain that Senior realized by selling the business to the family trust for 16 million with a 4 million basis is $12 million. And Senior can report that 12 million gain 20 years in the future when when the note is paid. So if the trust later sells, Senior retires, say 3 years later, and the trust gets redeemed for 18 million and paid 16 for the 25% interest, the trust basically has only a 2 million gain. So there's a small estate planning benefit. We've frozen the business at 16 million and shifted the future appreciation to the trust. But what's the income tax advantage to this? Well, wait a minute. I create a trust for the benefit of my descendants. It's my family. And I make it a non-grantor trust, and then I sell that family business interest to this trust for a 16 million note. I have a 12 million gain, and I don't have to report that gain until 20 years from now. And the trust only has to report 2 million a gain because it paid 16 million for the asset. Alan, that sounds too good to be true, doesn't it?
It does.
So
Absolutely.
Congress said, you're right, it's too good to be true. So Congress basically enacted a rule. Let's go on to the next slide.
It's the code section of the day, 453E.
And it's very simple. Congress said, that's too good to be true. So if senior sells the appreciated asset to a related party, that family trust for the benefit of my descendants, clearly a related party, and defers the reporting of that 12 million realized gain under the installment method, and the related party resells the asset it purchased from senior anytime within the next 2 years, the gain senior previously deferred under the installment method is immediately accelerated. So what is the advantage of senior retiring 2 years and 1 day later?
Deferral.
Right. The
Beautiful.
statute is basically saying what you can't do, but it's telling you that all the trust has to do is wait the 2-year holding period. And by waiting the 2-year holding period, the resale will not accelerate the gain previously deferred on the first sale under the installment method. So what that means is the trust gets 18 million of sale proceeds. Go on to the next slide. Okay, go on. All right, go on. Next one. Go on. All right. So hold on. Go on next. All right. All right. So basically, we had a small estate freeze. Oh, by the way, I didn't take any discounts. Why didn't I take any discounts? Because I wanted to maximize the income tax gain that can be deferred. So right away, one time I had one of these audited, and the estate tax examiner said, there must be something wrong. You didn't take any valuation discounts. I said, well, you don't like them. So the point is, in this situation, there's been a modest estate freeze, but more importantly, out of the 18 million of sale proceeds, the trust only has to pay taxes on a 2 million gain. And that's a 20% capital gains tax. So all of a sudden the trust is left with $17.5 million of cash that it can do whatever it wants with. So that is a very nice transaction. Whew.
Does the IRS like these or dislike them?
It doesn't matter what the IRS likes or dislikes. They're bound by the statute. And every time I've had these audited, well, the first time I had it audited, the IRS lawyer who was looking at it said, this sounds too good to be true. And then I said to her, who taught you income tax in law school? And she said, you did. So I said, didn't you remember when I taught this to you? And she said, oh yeah, it works. In other words, it's right there in the statute. And we don't take any valuation discounts because we want to maximize the income tax deferral. So it's a very nice transaction.
You know, Jerry, every once in a while, my receptionist, who's always somebody new, says, I had a call from a Professor Calfee at the University of Florida, and he said, if you don't call him back today, he's going to change your partnership tax grade. You might want to use that line.
For 20 years ago.
So, Jerry, I'm going to say that you've been involved with the two most notable tax institutes in the United States, the Heckerling Institute, which you have a beautiful video on YouTube, and the Notre Dame Institute, which you've been the director of for several years now. And what I love about the Notre Dame Institute is that you personally pick the topics and tell the speakers what to make sure they cover, to make sure that it's new areas that are different and interesting and quite candidly need to be covered. You require that the speakers prepare papers, just like in the old days when we were required to prepare papers for everywhere we spoke. And you run it in dual sessions so that every hour the participant can pick a intermediate or an advanced session. And I love the fact that it's 2 days long. That's about as long as anyone can actually handle psychologically and emotionally of learning tax and estate planning. I particularly like that my partners, Chris and Brandon, are going to be speaking on slats from 3 p.m. to 5 p.m. October 20. I like the fact that this is going to be a cyber program so that I can get live recordings and listen to them anytime I want. And in fact, I like to listen to these at 1.5 times speed. I find everybody sounds like Mickey Mouse, but it's faster and I have better attention that way. And I listen to them using the Timmy system where I can also see what they're saying. Timmy prints out the words while the person is speaking when you replay it at 1.5 times speed.
Well, here's something very interesting. First of all, what do Brandon and Chris have in common with respect to me?
Well, Chris was one of your students at
They both
were. Oh, was Brand? Oh, that's right. I didn't remember that.
They were both my former students. And most of these programs, they give the speakers 45 or 50 minutes to speak. I increased the program to 60 minutes. And I told all my speakers, the extra 10 minutes is not to add new materials. The extra 10 minutes is to start out with a review of the basics. And for the slat thing, it's 2 hours. So they're going to basically, on the slat program, really go step by step with all the basic details, because it's hard to squeeze everything in 1 hour. So I gave them 2 hours. Now here's the big advantage. It's one thing sitting for 8 hours in a live program. Notre Dame is virtual this year. It's another thing to sit in front of your computer screen for 8 hours. Oh. So what we did is, and bus I have dual sessions because you only listen at one session at once. So a lot of people said that what they liked about Notre Dame was they didn't have to sit there for 8 hours. Like one person said, I just listened to the morning sessions and did other things in the afternoon because we made the recordings for every single session available as part of your registration fee for 6 months after the Institute. So basically that meant it gives you the luxury of having the ability to listen to everything at a more leisurely pace.
Right. So I hope everybody considers signing up for this program. It's a tremendous program. When you compare it to the other programs, because of the depth, I mean, look, Jason Havens, I see here, is going to spend an hour on the impact of mortality tables on charitable split interest trusts. He's going to really be able to give us a deep dive and a much better understanding of
basically, everybody knows what the charitable planning techniques are. Jason is going to show how you can arbitrage interest rates and the mortality tables that actually increase the income tax and state gift tax benefits of these charitable giving techniques in ways that you hadn't thought of before.
Yep. Yep. Okay, so Jerry, I really appreciate you joining us. Next time we'll make sure your camera's working.
I'll figure it out in advance.
Yep. We have a lot of questions we weren't able to answer. We will be back, or I'll be back next week. And Jerry's always welcome. If you have any questions, comments, or suggestions for us, we appreciate it. We're having a great time with this program. And thanks for listening. And we hope that you can use this knowledge to help your family and to help others. Have a fantastic day.
All right. Thank you, Alan, for inviting me. I appreciate it.
All right. My pleasure always. Take care.